Hello, everyone. Welcome back to another episode of Elevate Daily, your go-to channel for valuable insights. Today, we're delving into a subject that might make you feel a bit uneasy: IRS audits. Just hearing those three letters can make anyone nervous, right? We totally get it. But here's the exciting part. In this video, we're going to break down the whole IRS audit thing, making it super easy to understand, especially if you're someone making less than $300,000 annually. No need to stress, we've got your back. So grab a comfy seat and let's explore the intricacies of the IRS audit process together. Ready? Let's jump right in. Factors influencing IRS audits. Now let's dive a bit deeper into the factors that the IRS considers when deciding to audit someone. The amount of money you make, known as your income, is a key player in this audit game. People with higher incomes are more likely to get the IRS's attention. Why? Well, it's because if there are mistakes or things missing in their tax returns, the IRS can potentially collect a lot more money from them. But hold on. It's not just the big earners under the IRS microscope. Even if you don't rake in the big bucks, you're not off the hook. Low-income workers, especially those who claim the Earned Income Tax Credit, also find themselves on the audit radar quite often. So whether you're stacking up the dollars or making ends meet, the IRS might still come knocking to check your financial paperwork. Types of reporting on tax returns. Understanding how you report your income is another vital aspect that can significantly impact your chances of an IRS audit. The method of reporting, like utilizing Schedule C for self-employed individuals, plays a key role in determining your audit risk. For instance, self-employed individuals, sole proprietors, and single-member LLCs often report their income using Schedule C, which can potentially raise red flags due to the complexity of business returns. This complexity is particularly notable for businesses engaged in cash-heavy transactions, like those in the restaurant, beauty salon, or food truck industry. The IRS tends to pay closer attention to such cases, as businesses dealing with significant cash transactions may inadvertently miss reporting all income accurately, increasing the likelihood of an audit. So, it's important to be mindful of how you report your income, especially if your business involves cash transactions, to lower the chance of getting unwanted IRS attention. Red flags. Red flags serve as indicators that might attract the attention of the IRS. These signals can include substantial losses reported in Schedule C, overly high deductions for home office expenses, incomplete information, and disparities between the income documented and the income reported. Additionally, engaging in numerous cash transactions, a common practice for businesses such as restaurants or beauty salons, can also heighten suspicion. It's crucial for individuals and businesses to be vigilant about these potential red flags, to ensure compliance with tax regulations and avoid triggering audits or inquiries from tax authorities. Chances of being audited. Now, let's delve into the important question. What are the odds of undergoing an audit if your income is below $300,000? The statistics vary annually, and as of 2022, approximately 0.38% of individuals filing taxes found themselves subject to an audit. It's worth noting that the risk isn't uniform across income levels. If you fall within the $200,000 to $300,000 income bracket, your audit risk escalates to 0.49% without Schedule C and reaches 1.03% with Schedule C. Conversely, for those with an income below $200,000, the likelihood of an audit decreases to a mere 0.9%. Interestingly, individuals with lower incomes who claim the Earned Income Tax Credit encounter a somewhat elevated risk, standing at 1.27%. These figures shed light on the nuanced landscape of tax audits, highlighting how income levels and specific tax credits can influence the likelihood of undergoing scrutiny by tax authorities. Tips to decrease audit risk. Let's delve a bit deeper into some straightforward and practical tips to help minimize the chances of an IRS audit. Tip number 1. Making sure that all of your income is properly reported on your tax return is very important. This includes money you get from other sources besides your normal job, like capital gains when you sell stocks, dividends, interest from savings or investments, and even money you make from crypto transactions. Remember that the IRS wants to know about all the money you make, so making sure that you report all of these sources of income correctly can help you avoid problems during an audit. Being careful about how you report your income makes sure you're on the right side of the tax man, whether it's from stocks or a side job. Tip number 2. Be very careful when you want to subtract things, especially for your home office or other big costs. Telling the IRS that you spent more than you did or that your home office is bigger than it is might get you in trouble with the IRS. Say you work from home and want to claim a home office deduction. You need to be accurate about how much room in your home you use for business. It could be a red flag during an audit if you say that your home has an unreasonable amount of space. Being honest and correct with your payments is the most important thing. Make sure that they match up with the real costs you had. Not only does this make it less likely that you will be inspected, but it also makes your tax returns appear better. Don't forget that being honest is the best way to get tax breaks. Tip number 3. Not only should you use tax software, but you should also think about getting a tax professional if you have trouble navigating the complicated world of tax laws. Some people call them tax planners or certified public accountants, CPAs. These people know how to make sure that your tax return is correct and meets all the rules. You can get advice from them that is specific to your finances. This will help you get the most out of your taxes and lower your risk of making mistakes that could lead to an audit. While tax software can be useful, it may not be able to fully grasp your unique circumstances or pick up on small details, as well as a real tax-skilled person. Having a tax pro by your side is the best way to feel at ease during tax season, and maybe even save money in the long run. In conclusion, if you make less than $300,000 a year, you don't have to worry about the IRS auditing you. To lower your risk of being audited, you should still look out for possible red flags in your tax reports. Making your taxes go more smoothly can be helped by being aware of what's going on and doing something about it. Thank you so much for watching today's video. If you enjoyed the content and found it helpful, don't forget to hit the like button and subscribe to our channel for more insightful videos. Your support means the world to us. We strive to provide valuable content, releasing 3 new videos each week that delve into crucial topics discussing health, wealth, and relationships. Until next time from Elevate Daily.